Hi, Gabby Serrano with HomeSmart. Now I have Erica Dose with Homeowners Financial Group.
Erica Dose. I'm with Homeowners Financial Group. I am the team lead for the Dose team. And today I want to go over kind of what a buyer consultation looks like when they first meet with us after they have a pre-approval issued, so they understand what their financing options look like. There is several different ways to structure a loan, and we're also going to discuss how concessions can impact the buyer and what they qualify for. And then we're also going to go through different loan programs and what is available with the Homeowners Financial Group. Okay, so we do have our non-QM loans, and non-QM is a non-qualified mortgage product that helps your buyers that do not qualify for a conventional loan, an FHA loan, or a USDA loan. And these give your buyers more options to qualify with alternative income sources. So for your self-employed buyers, this helps them qualify without needing to look at their tax returns and look at what the actual income they report to the IRS. That's typically what we need to qualify. But on a bank statement loan, we're going to look at the total deposits, a percentage of the total deposits going into their business bank accounts over the last 12 months that could significantly increase the buying power for your self-employed buyers.
Thank you, Eric.
Yes, thank you, Gabby. Is this form right here. So every buyer that we meet with, I like to do a Zoom call or an in-person meeting to go over their financing options. This software is called Mortgage Coach, and it does a really good job of putting different options side by side that I like to go over with the buyer. I don't print it out like this. This actually, if I share my screen, I can highlight different numbers, and I can show them how to utilize this site to get all the information they need, so that after we get off the call, they have the tools they need to kind of really dive into what their options look like, so they have a really good understanding. I'm not one to just send out 15 different loan estimates. Most buyers, even experienced buyers, do not understand how to read a loan estimate. It is a 5-page government document that does not quite lay it out in a way that allows them to really look at multiple things at one time. So for here, what I did is just a scenario of a purchase price at $500,000. So you can see property value across the top. The house they're looking at, they want to put an offer in for $500,000. They're going to put 5% down, and today's interest rate is at 7%. Might be 6.875% today, because rates came down surprisingly this morning. And then it does give them their payment. That $4,045 is their principal and interest, taxes, insurance, and PMI payment. And then it tells them what their cash to close is. So that is their down payment of 5% plus their closing costs. So they want to put an offer for this house for $500,000. Now I'm going to show them what if they put an offer for their second option at $515,000, and we ask the seller to give them $15,000 credit to buy down their interest rate, because they like this this payment of $4,045, but it's a little bit out of their budget. So if we have the seller, we give them a little bit of a better offer, ask the seller to give them a $15,000 credit so that they can buy the rate down from 7% down to 6.125%. We're going to show that their payment actually goes down to $3,879. So that saves them $166 a month. And that monthly savings is right below as well. So they're actually paying more for the house, but saving $166 a month because of the lower interest rate that the seller is paying for. Their cash to close is $41,227. That's relatively the same as the first option at a purchase price of $500,000. So this gives them an option of how they can structure this purchase to get the payment that they need in a higher interest rate environment. Okay. The third option, so that second option, that 6.125, is what we would call a permanent interest rate buy down. So that rate is 6.125% for the entire 30-year term. The third option is doing the same thing. We're going to ask the seller, we're going to give the seller a price of $515,000, ask them to give a $15,000 credit to help pay for this temporary buy down, otherwise called a 2-1 buy down. So this helps them obtain a lower interest rate for the first 2 years of the loan. So the rate's gonna be 7%, just like the first option, but for the first year, that rate is gonna be reduced to 5%. So that's a 2% reduction for the first year. At 5% interest, that payment is $3,533 a month. Now they're saving $500 a month for that first year. Their cash to close, $38,223. So very similar to option number 1. Now after that first year, that rate is gonna go from 5% to 6% for the second year. And then the third year, it goes to 7%, and then it does not exceed 7%, because that is the interest rate for the remaining term of the loan. So the goal on option number 3 is for them to have the opportunity to refinance in the next 2 years before that third year, before we see that 7% on year number 3. Okay? So that is, if you have a buyer that's a lot more payment conscious and they're really comfortable and confident that they'll be able to refinance in the next couple of years, that third option is a good option as well. But some buyers are just not comfortable with their payment changing at all, and that's where payment number 2 becomes a better option. So to me, it's really important to give buyers a lot of different options so that they can make a decision that's best for them, not just pointing them to what you think is in their best interest. We can always give advice, and I always give advice, this is what I would do. Because my opinion has actually changed over the last 3 years. I was doing a bunch of 2-1 buy downs because I thought they're great. You know, rates go up and rates come down. But we've been sitting at rates close to 7% for 3 years. So I'm starting to push more of a permanent buy down option myself, because we just don't know what is going to happen. It's like we live in opposite world, right? What we think is going to happen is not really panning out. So I always make sure we have conversations over the risks and benefits of each option. And then that third option, I do like to show them what their opportunity would be like 2 years from now if rates do come down. Because right now, if they take, option number 2, this is the highest their payment's ever going to be, right? So what if rates do come down to 5.5% or lower? 2 years from now, if they refinance, they're going to have a little bit more equity in their home, most likely. They're going to have paid their mortgage balance down to $481. If they can refinance to a rate of 5.5%, they are now going to be at a payment of $3,629, and that saves them $416 a month compared to the first option. So that kind of shows them what that future could look like in the home. But the best part is, when you buy real estate, you really have more of a fixed payment. In California especially, because our property taxes really don't change a whole lot. Now insurance is another game changer, but I think we're kind of at the peak of that right now as well. So that is the main part of the slide or the presentation. And then when they click through different screens, it gives them a lot more information. So that second screen here is going to show them their monthly payment difference between each option. The third screen I like to show them, because this is a 5-year analysis. This is going to show them how the numbers really work. So in the first 5 years, doing that higher priced home with a higher loan amount, they're still saving $16,789 by having that lower interest rate. So they paid more for the house, they're financing more, but they're still saving a significant amount of money.
They are in there?
They are in there at 1.25%.
Okay.
So then we can go over their savings over the first 5 years, because on average, people only hold on to a mortgage for 5 years. So I like to use a 5-year period. Yeah. Obviously, the last option, if they refinance, saves them the most amount of money, but that is not guaranteed. And then going through the third option, it shows them the total interest paid over the first 15 years of the loan, so they can see how much interest they're paying between each option. And then the next, that is the savings over the first 5 years. And then page number 5 is gonna show you the payment breakdown. So you can see the principal and interest, the property tax, the estimated homeowners insurance, and the PMI, and the monthly payment. So that's page number 5. And then page number 6 takes them through their cash to close. So how we come up with that bottom number of that $40,000 range that they have to pay at closing. So we walk them through how those numbers break down. So on that first row, their down payment is $25,000. And then to that, we're gonna add in their closing costs, which is gonna be pretty close to $9,000. Then we're gonna add in their prepaids. So we go over what prepaids are, their first year's homeowners insurance premium, and then the amount of money that we're gonna collect to establish their tax and insurance impound account with. And then that's how we come up with the cash to close. So their down payment plus closing costs plus prepaids is their cash to close. And then we also discuss on option 2 and 3, how that seller concession comes in. So the difference here is their down payment is a little bit higher because they're paying more for the house. Their closing costs are gonna be relatively the same, but now they have this interest rate buy down points. So this is the cost on option number 2. That $14,667, that's what they're going to pay to obtain that lower rate of 6.125%. So that gets added in along with their prepaids, and then we subtract the seller credit, that contribution from the seller, so we can show them that washes out the points.
Right.
And then the difference here is the cash to close. Now the points are still tax deductible to the buyer too. So they get to write that off in the first year that they do their taxes. So this is all on a computer screen, which I can click and highlight so they can kind of follow along. It's a little bit easier than the printout, but that is kind of a little bit of what we go through after we've issued the pre-approval, and we go over kind of what their options are. Now, if they're like, hey, that payment is still too high for me, I really want my payment to be here, then I'll be like, okay, well, let's change this purchase price down to $400,000. Now your payment is right where you want it to be. And they're like, well, I can't find a house for $400,000. Okay, so then we know we need to be somewhere in the middle, or we just need to go over what would make them feel more comfortable to get to that payment. So they're comfortable proceeding forward. And maybe restructuring their debt. It might be coaching them through paying off some credit card bills, or putting less money down and paying off some debt, because most buyers have a significant amount of debt. It's surprising how they're comfortable with their car loans and their credit card debt, but they're not comfortable with the mortgage payment.
Exactly.
So it's just kind of guiding them through how to maybe restructure that a little bit so that this payment is doable. So that's really the primary focus of our job when we meet with the buyer to go over their payment options.
Those people that you are getting pre-approved, that you need to preface with them that there's certain things that we need to feel comfortable issuing that pre-approval, and a couple of things are required before we can even issue that pre-approval. One is a copy of their driver's license. That is very important. We cannot issue without that. Pay stubs and W-2s, and what we mean by pay stubs is sometimes we will need a year-end pay stub from both 2023, the previous 2 years. So currently it would be 23 and 24, because that breaks down all of their like overtime and bonus and regular pay. But we need that for both years. We also need W-2s from both years to show the history of the employment, even if they've switched jobs in that 2 years. We need all the W-2s for every employer that they've worked.
Conversation, which is the next little form here I have here, this packet, is our underwriting guidelines for non-QM. So non-QM loans are becoming more and more popular as more and more buyers have multiple jobs, multiple streams of income. So these are non-conventional loans. So these are not loans that Fannie Mae, Freddie Mac, FHA, VA, or USDA are going to do. So those are all agencies that are backed by the federal government. So these are loan options for buyers that don't quite fit in that bucket. So So what is non-QM lending here? It is, like I said, non-QM, it stands for non-qualified mortgage loans that do not meet CFPB's qualified mortgage guidelines. So these are not like bailout loans from the federal government. So a QM loan means we have to stay within a certain debt ratio, we have to verify income, we have to verify the ability to repay. For the lender, conventional loans to be backed by the government if that buyer were to default. Then the government would help securitize that property from being foreclosed on. Knowing that if the buyer doesn't make the monthly payments and it does go into foreclosure, they're at risk of losing a substantial amount of money. But they charge typically a little bit of a higher interest rate due to that risk. So these are designed for borrowers who do not fit in the traditional income documentation requirements and provides more flexible underwriting. Your self-employed buyers, your real estate investors, your foreign nationals, your high net worth individuals. Sometimes your more wealthy buyers do not want to hand over all of their sensitive private information. So they may go into a loan type that has a higher interest rate where all this documentation is not required. Your credit challenge borrowers and your property flippers and some condos. So non-QM is more flexible on the condo guidelines than a conventional loan. So types of non-QM loan programs, bank statements is the most common one. So for a business owner, instead of looking at their tax return, that could show very little income because they write off all their expenses, because that is on a conventional loan, we are looking at the income after all of the expenses are written off. So your borrower thinks they make $500,000 a year, but to the IRS they show that they make $50,000 a year. We're going to use the $50,000 for a conventional loan. On a bank statement loan, we can look at their last 12 months business bank statements and take a percentage of their total deposits and use that as income instead. And then we have our debt service coverage ratio. Those are for your investors. Those are your investors that are buying properties that we are only going to qualify them on the cash flow of that property. So we're going to look at the market rent for that property and we're going to compare it to their monthly payment. And as long as they're similar, we're not going to verify any income. We actually don't even put employment or income on the application. We just approve them on that alone.
And you need the credit score, right?
And we need a credit score, yes.
You may hear
Credit considerations and faster approvals. And then the risks and considerations, they do have higher interest rates typically, although our DSCR loans are for investment properties are almost identical to a conventional loan. So it's like, why? Why do you want to hand over all this paperwork if you don't need to, if the rate's going to be the same? They do typically require a larger down payment. So we're needing typically between 10 and 20% down on these types of loans. And then every investor has a little bit of a different guideline. So you have to do a lot of digging through to find the right investor. And there could be some prepayment penalties. So prepayment penalties are coming back and becoming more popular in these types of loans, which also helps you secure a lower interest rate. Over the last 12 months, that could significantly increase the buying power for your self-employed buyers.
Thank you, Eric.
Yes. Thank you, Gabby.